Hello everyone and welcome to our yet another session under the taxation of employees, and we are continuing from where we stopped in session number 1, and in session 2 we are moving into the benefits in kind. Now section 19 subsection 1 expands and widens the scope of employment income to include benefits in kind. Benefits in kind. So benefits in kind, ideally you would see that with benefits in kind, section 19 is trying to go beyond the monetary payments, as we have seen the allowances and the salaries and whatever, as we have seen in the previous discussion. So we go beyond those monetary payments to include the value of any benefit, advantage, or facility granted to the employee during the year of income. The law, of course, have been structured and has been based on research, and some of the types of benefits in kind out there that are recognized within the law include private use of a motor vehicle. Now, private use of a motor vehicle will arise where the employer provides the employee with the use or availability to use a motor vehicle wholly or partly for private purposes of the employee. Domestic assistants include housekeepers, chauffeurs, drivers, gardeners, security guards as part of the benefits in kind. We have entertainment, including meals, refreshments, and so on. Utilities, including water, electricity, internet, telephone. It even goes up to low interest loans, where the employer provides the employee with a loan whose total value could exceed even £1 million, with no interest or at an interest rate, usually below the statutory rate set by the Bank of Uganda. Then we have waiver of debt obligation, which arises where the employer decides to waive a debt wholly or partly the employee. Transfer or use of property or provision of a service, where the employer transfers the property to the ownership of the employee or avails such property to the employee's use or provides any service. Then again, accommodation, and of course here we are looking at houses directly owned by the employer, or the houses that are let by the employer on behalf of the employees. So these are the different types of benefits in kind that will be examined on. But as you can see, some of these are non-monetary. So how do we determine the monetary value? How do we monetize these benefits in kind? So as a general rule, the value of a benefit in kind is the fair value of the benefit on the date it is taken into account for the purpose of tax, for the tax purposes. However, we also know that certain employers have schemes to provide benefits in kind as long as you make a small contribution for the benefit in kind. So when we are doing the evaluation of the benefits in kind, we deduct any amount paid by the employee for that particular benefit. So all in all, the pro forma will look like this. We shall get the fair value of the benefit less any amount paid by the employee. The figure we get is the value of the benefit. So running through all these benefits in kind, if I can begin with the domestic assistance, what will happen is that we shall get the salary paid to the domestic assistant by the employer. If the employee makes a contribution, any payment made by the employee, we shall deduct it in arriving at the benefit derived from domestic or provision of domestic assistance. So we have that activity there where the company decides to pay for the employee's gardener 150 million per month, and the employee is required to contribute 20,000. So the benefit derived in this case would be 130. We get the remuneration paid, the 150, minus the contribution 20, so that's the 130. So the 130 is going to be grossed up and is going to form part of the employee's chargeable income. If the employee does not contribute anything for this benefit, then the value of the benefit will be 150. When it comes to meals and refreshments, we shall get the cost of the meal, okay, to the employer that has been provided to the employee, less any consideration paid by the employee. Whatever we get will be the value of the benefit. So in activity 2, we are looking at the case where the employer provides meals to the employee for 26 days in a month, and the cost of the plate is 3,000. So we multiply 3 times 26, we end up with 78,000. So 78,000 becomes the benefit derived. When it comes to utilities, you get the cost of providing the utility less any payment made by the employee for the utility. The figure we get is the value of the benefit. Then number 4, we have transfer or use of property or service. We get the market value of the property or service less any payment made by the employee. The figure we get is the value of the benefit. Here we can look at things like a laptop. You can be using the laptop of the employer, especially the auditors. When they are going to the field, they're given those laptops. So ideally, if you did not have that position with the employer, what would be the cost of the laptop in the market? What would be the market value? So that's what we get. If the laptop is going to cost you 2 million, we get a 2 million here, less any payment you have made, if any. The value of the benefit will be the 2 million. Waiver of debt obligation, we get the actual relief granted, less that's going to be the value of the benefit. So in activity 3, we demonstrate that. And here we are talking about an employee in the month of January 2021 had a loan with the bank of 300,000, and now because they were chasing around the employer decided to pay the bank. And when it came to 31st of January, paying the employee's salary, the money was never deducted, was never recovered from the salary. So in that case, we shall say the employee enjoyed waiver of debt obligation as a benefit in kind, and is going to form part of the chargeable income. Then number 6, we have low interest loans. That is the formula, and those are the parameters of the formula. Okay, those are the parameters of the formula. RST is the statutory rate of interest as set by Bank of Uganda. R is the rate provided by charged by the employer. L is the loan. M are the number of months in the year you enjoyed the loan, and then I are the 12 months. So in this case, we are talking about an employer who has given an employee school fees loan 400,000, furniture loan 500,000, appliances loan 300,000, and the interest rate is 10%. Yet the statutory rate is 15%. So what benefit does the employee enjoy here? So we shall subject the total loan. Now when you add 400 plus 500 plus 300, you get 1.2. So if you had picked the 1.2 from the market, you'd be charged 15% statutory rate. But now you picked the 1.2 from your employer and is charging you only 10%. So what's the difference between the two? interest rates. 180 is in the market, 120 is the employer's rate. So 60,000 is the saving you have made on the loan because it was acquired from your employer. The 60,000 will form part of your employment income. However, something you should note here, if the loans are below 1 million, they are exempt. They are exempt, and the low interest loan benefit will not apply. That is note number one. Note number two is on the advances, salary advances. If you get a salary advance, if these were salary advances and they total up to 1.2 in the year of income, by the way, you could have got the 400 in January, the 500 in May, the 300 in December. If we total within the year and we find that you exceeded 1 million, because employers have that tendency of splitting those loans so that they don't exceed 1 million, so that the employee does not bear the burden of tax. Even if you do that, when we add and see that within the period you've actually accumulated a loan of 1.2, the tax point will be the point when the loan shoots over and above 1 million. That's when it becomes a taxable benefit and ceases to be exempt. I hope you've noted that, members. Now, a salary advance is a loan. Did you know that? A salary advance, the government is clear, don't advance people money. The minute you advance them money, they must clear within 3 months. So it means that if it is January 2021 and I give you an advance, you must pay back. I must recover that advance in 3 months. From your salary of January, from your salary of Feb, and your salary of March, I must recover. As the employer, I must recover that money. A salary advance is a loan at 0%. You have given someone. These are ways. I have told you that employers have monkey tricks. Instead of giving you a loan, I will say, actually, if you get a loan from your employer, it is a salary advance. They have advanced you your money. You look at it in that way. If you say that I'm getting a loan from my employer, how are you going to recover that loan? How are you going to recover? How does the employer recover that loan? The employer can only recover that loan against your salary. And unless it is not an intelligent employer, you cannot give your employee 500 million when you are paying them 100,000. How are you going to cover the 500 million? So you must give, ideally the scheme would be, or the policy of the company would be, you give employees loans that are within their reach, depending on how much you're paying them. So you can agree and say, okay, according to the rule, globally acceptable rule, I shouldn't take more than 50%. Even when you go to the bank to get a salary loan, the bank cannot take more than 50% of your salary. So here you are, you have given the employee a loan, an advance. This advance must be recovered. The law is that you only be exempted from taxation if the advance is recovered within the first 3 months. If you exceed the first 3 months, it takes a year without recovering the advance, that advance is going to be regarded as a benefit in kind. It's going to be regarded as a low interest loan benefit, as long as it exceeds 1 million shillings again. So instead of using this 10%, we shall use 0. You don't pay any interest. So it means the benefit comes to 180. You see that? The interest rate for advances, the interest rate is 0%. because you are given an advance at no interest. The employer advances your money, actually your employer loses because of paying you early. They lose. They would have invested that money somewhere, they earn interest, but they have decided to advance you that money, so they lose. So clever employers, those of you who are employers here, don't give advances, give them a loan. So that if you want a salary advance, I don't give you. Why? Because I will lose money. So what I do, I give you a loan. I just sit you down and say, okay, how much do you want? Say, sir, you want 1,000,000 shillings and I'm going to pay it back in 2 months. Okay, fine. This 1,000,000 shillings, what we are going to do, I will not give you an advance, because with the advance I will disturb you a lot. I'm going to give you a small loan, but below the what? I charge you 6%. You see, where I'm getting 6% is here. 6% is interest from government securities like treasury bills. Because this 1,000,000, I'm going to get it and give it to my employee. I would have invested this 1,000,000 in treasury bills and I earn a clean 6%. Now you're denying me this 6%. So what I do, I give you a salary loan. I don't intend to sound bad, but I give you a salary loan at 6%. But in my mind, I know I'm not going to make a loss. Because one, if I give you an advance of 1,000,000, remember this is my 1,000,000. I'm giving you ahead. You haven't done the work, but I've decided to give you this money ahead. I have two things. One, I could use that money on the treasury bill and I earn my 6%. But at the same time, by the time I recover the 1,000,000, it is no longer 1,000,000. It has been eaten away by inflation rate. Actually, what I would do, I would add the 6%, and then if the inflation is also at 6%, then it means that I'm going to give you a soft, I would call it a soft loan. I give it a nice name so that you like the money. Soft loan. Let me give you a soft loan, a friendly. You can even call it a friendly loan. So that the employee does not look in your eyes and say, this man here. Can you imagine this man is giving me a loan? So you use a nice term. Let me give you a friendly. Because you're going to fall. If you're running a business, you're going to collapse. And you're giving employees loans, advances, you're going to collapse. That is loss number one. So you give it a nice name, a soft loan. Let me give you a soft loan. Let me give you a friendly loan, a company loan, some nice term. But in your mind, the calculation, you're covering for inflation. At the same time, you are covering that opportunity loss. There's what you call an opportunity loss. That money would have been invested in treasury bills and you earn a clean 6%. So become clever managers. I've given you that hint. But two major key takeaways on the loan benefit is: one, the loans must be above 1,000,000. Number two is that if you get loans in pieces, the minute they exceed 1,000,000 and they have not yet been paid, that month when you exceed 1,000,000, you begin computing the benefit in kind. That's number two. Number three, salary advances are loans at 0%. They are supposed to be recovered within 3 months. So the examiner is tricky. He will give you a scenario where the employee did not pay the employer did not recover the advance in 3 months and exceeded by maybe 5 months. So you have to calculate the low interest loan benefit. So those are the issues surrounding this. Then we have private use of a motor vehicle. Again, this is another one. Private use of a motor vehicle. Now, this one arises where you are given a vehicle to use for private purposes. Why I'm saying private purpose? In most cases, the intention is not for you to enjoy for your private purpose. The intention is to ease your movement, but you find that this motor vehicle is actually used for private purposes. How? We are going to see. Now, the formula to monetize the value of this benefit is on the screens right now. We get 20% times A, B over C minus D. So what is A? A is the market value of the motor vehicle at the time it was first provided to you for private use. Okay? Depreciated on reducing balance basis at a rate of 35% for the subsequent years. B that we have in our formula here, the number of days in the year of income during which the motor vehicle was used or available. You see that? Or available for use for private purposes by the employee for all or part of the day. We are going to see that. C is the number of days in the year of income. This one here, the denominator. And then D, as I mentioned, always these employers have those schemes where they, of course, ask for a contribution from you, maybe maintenance and so on. So D that we have in our formula here stands for any payment or contribution made by the employee for the benefit. Now let's go into the gist of this. Now, private use, how does it arise? The URA or the government's asset test is, if you were not employed by the employer, if you were not working for that company, would you drive that vehicle? Of course, the answer is no. So, because you have that privilege, you must pay some money. Yes, fuel contribution, yes, it's part of it. Fuel contribution is part of it. So, private use is that this vehicle is within your reach. You can use it for things like coming from your home going to your place of work, and coming from your place of work going back home. That time alone is private in nature. Because you will see that section 22, among the deductions allowed, commuting of staff is a private arrangement. It's a private expenditure. Commuting staff to and from place of work is private in nature. So if you decide to give your employees vehicles, then this taxation is now going to be on the employees. They are going to pay the taxes on your behalf. But we know that this vehicle, within the day you're using it for official work. Fine. After using it for official work, how do you manage it? Of course, you take it home. So that time you enjoy, whereas others are also employed but they don't have vehicles, for you, you're privileged. So you must pay a tax on that. Then we are talking about weekends. This vehicle is within your reach over the weekend, even on public holidays. So you enjoy that benefit. So the fact that you have this vehicle in your reach, you must pay a tax on that benefit. So drive the vehicle. That's why I don't blame these people who go to weddings in the company vehicle. They find the person at church in the company vehicle. During the burial, the company vehicle. I don't blame them because they pay taxes on those vehicles. Otherwise, if you don't want to pay a tax on that, then park the vehicle. After using it within the day, park it, get an Uber back home, get a boda back home, get a taxi back home. But why would you go into that pain? As we shall see, this benefit is very small. This may also include usage on affairs not directly related to one's employment, like picking your children from school. You can call your You call these people who your driver, Uber guy, not Uber guy, but your driver. You can call your driver to come and to come and pick your children, come and pick the vehicle, pick my children from school, take them home, bring back the vehicle. That kind of thing. Those are activities, affairs not directly related to one's employment, and that is private in nature and it is taxable. However, we know that there are some people whose jobs really require them to drive these vehicles throughout, like the marketeers, like the sales executives, like the chauffeurs, the drivers. If you're driving around the big man, really, do you have any other alternative? The vehicle is the tool you use to work. So in those circumstances, the benefit is not going to be applicable. Ideally, you're going to be exempt from such taxation. Finally, we have accommodation. As I've mentioned, accommodation is known to be provided to the employees in three major ways. There are houses directly owned by the employer. There are houses let by the employer on behalf of the employees. We also have housing allowance or reimbursement of rental expenses. Now, Part C is simple. This one here, very easy. For the case of housing allowance, the benefit is the amount of the allowance you have received, the money you have picked from your employer. So C is simple, but A and B are a bit complicated. So there's an extra computation. So in the case of A and B, the value of the benefit is going to be the lower or the lesser of the market rental value of the accommodation or housing, reduced by the payment made by the employee for the benefit, or 15% of the employment income. Now it means that for you to determine this benefit correctly, you must have done all the other parts of the question, because you need 15% of the employment income, including the market value up here. So we compare these two figures. We shall do an activity on that and you appreciate that. We compare the two values, and then what we get as the lower becomes the benefit in regard to accommodation. Alright, enough of the taxation. We know that not all incomes are taxable. Certain incomes are exempt from tax. So employees will also receive relief in some cases. And alright, so I want you to go to the next video that handles employee relief. And in this discussion, we shall look at the various incomes that are derived by the employee, which are not going to be subject to tax. So you can put all the points we have discussed in this session together and then move to the next lecture video. Thank you.